Hello, everyone. Welcome to this Monash Software Systems and Cybersecurity seminars. Today, we are very happy to welcome Allison Bishop, who is co-founder and president of Proof Trading, a broker-dealer for US equities. She is also the vice president of the IACR, International Association for Cryptologic Research, and a visiting professor at City College. She was formerly an assistant professor at Columbia University and a quantitative researcher at the Investors Exchange. You can see that she has experience in crypto as well as finance things. And the topic is also in this area. So she's going to talk to us about the cryptographer view of the US market. Thank you, Allison. The scene is yours.
All right. And just so I'm aware of time, so this is an hour with time for questions-ish?
Yeah,
okay.
With questions, yeah.
Okay. Yeah, so hi, everyone. Thank you for having me. This is a topic near and dear to my heart, so I'm always excited to get a chance to talk about it and try to show cryptographers and cybersecurity people some of the interesting problems that are going on in the US stock market that I think are great low-hanging fruit for research for people who think about these things in a cybersecurity kind of mindset. Since I'm going to be covering a lot of financy stuff, especially financy stuff that's kind of specific to the US market, I'm going to try not to assume that people have seen it before. I had not seen or known any of it before a few years ago when I started working in this area. So please stop me with questions, interrupt with questions along the way. So that I'm not glossing over something that's bugging you or that you're going to be thinking about as it goes. So please feel free to interrupt with questions as we go along, and I'll try to save some additional time for questions at the end as well. But no reason to hold them as we go. So what I want to talk about today is I used to have a disclaimer on the title slide of this talk and be like, no, it's not about cryptocurrency, although it's becoming a little less necessary, as at least in the US, the cryptocurrency craze is kind of winding down a little bit at least. But this is just going to be a talk about the regular US stock market and what I think are some interesting information security style problems or privacy style problems really that sort of live in this space. And so I'm going to give you a little bit of an overview of the structure of the US market that's relevant to understanding those problems. So perhaps flipping what a sort of normal academic talk would be, where I give an abstraction and then I give an example, it's going to be kind of the opposite. We're going to wade in the weeds of the details of stock trading a little bit, and then we're going to extract out from it a nice kind of abstract information theory problem. And at that stage of solving that problem, I should highlight that this is a joint collaboration with many great young researchers. So all of whom you see here, we've just submitted a paper to PETS actually that we're going to be putting it on ePrint soon. So this is a collaboration with a lot of people involved, and all the good stuff you're going to see is due to them, and any mistakes are mine, of course. So that's the sort of the context for this. And before I get into the weeds too much, I do want to explain a little bit about my background and sort of how I sort of wound up in this position of sort of working in stock trading and cryptography. Once I started working at IEX, which is one of the stock exchanges in the United States, of which there are, I think, 16 at the moment. I ended up running into Michael Lewis, who wrote the book Flash Boys about IEX. So he was hanging around sort of signing copies for people. And he asked me sort of what I do for IEX. And I said, well, I'm a quantitative researcher, but I'm also a cryptographer. And his 10-year-old son was with him at the time. So he asked me to explain to his son what a cryptographer was. And I said something kind of terrible to understand about how we secure information or something like that. And he cut to the chase and explained it as a cryptographer as a person who designed puzzles. And I think that this is true in so much as, that's a part of what cryptography does. But actually, I think the analogy between cryptography and the stock market and many other sort of complex information systems gets much more to the why sort of cryptographers design puzzles, which my definition, having had more time to think about this now, is the cryptographer is a person who facilitates communication and sort of redraws the boundaries of what's possible in terms of what we can communicate while still sort of controlling information in the ways that we want to. And through this lens, I actually think there's a lot of overlap between the way that I think about cryptography and the way that I think about understanding the US stock market. Because ultimately the US stock market is a network. It is a decentralized system of computers who are in some sense computing a multi-party computation. They're sort of pinging messages back and forth, and they're sort of continually communicating in order to compute things. But when you look at this from an interdisciplinary lens, if we sort of ask what seems to be the basic question, sort of what is the stock market, we end up with a lot of different answers depending on sort of what discipline you're coming from. The sort of historical answer was a place to trade stocks. In fact, it was literally a place. It was a tree here in New York City called the Buttonwood Tree, where people would meet to trade stocks in the super early days. Since then, of course, it has evolved, and it is now just sort of functionally actually a set of companies who match trades for profit. So places like the New York Stock Exchange and NASDAQ are companies that make a profit off the service of matching buyers and sellers into trades. It functions as a communication network whose stated purpose is to crowdsource the value of companies. So there's a way you can think about this in a kind of social networking kind of lens. From an economic theory perspective, someone might say that it's a mechanism for efficiently allocating capital, trying to decide sort of where dollars should be going for the good of the economy and sort of crowdsourcing that. Historically, it's been an engine for economic growth, and of course, you know, there have been claims with various levels of justification that it is really just a form of gambling, and that there are various kinds of injustices inherent in the rules. And so when you start to look at all these explanations, you start to see a really interdisciplinary approach starts to become necessary if we think about all these things. So in the sense of understanding the profit motives of all the companies and players involved, we need to draw upon sort of economic theory and game theory. And in understanding the communication network that underlies all of this, we need to draw upon computer science and many different subfields of computer science within that. There's also the speeds at which this information travels get all the way into the sort of physics of microwave towers and fiber optic cables, and people trying to optimize that stuff down to the microsecond. And ultimately, of course, on top of this, you have the challenge of understanding the psychology of all the human participants and traders and executives and policymakers and regulators and all the people who make the decisions about this. And so I would certainly argue that computer science has a kind of central place in the study of the stock market. And yet historically, this has been an area sort of mostly studied by economists and sort of not as at least academically studied by computer scientists. And the way that we frame this as a computer science or as a math problem really matters, because often the math or the computer science in the sort of like prediction kind of sense is kind of the easy part, or is sort of the low hanging fruit that's been studied before, but not really where the real action happens. So this is an example of a model that I built when I worked at IEX on the problem of stock price prediction, which, if you've ever played around with stock price prediction, is a notoriously hard problem. But it turns out it isn't hard at the scale of a millisecond. And so all the reasons that sort of prices in the stock market evolve over time and change based on news or change based on earnings reports or supply and demand and all those kind of shifts in the market, if we narrow down our time scale to like 2 milliseconds or less, none of that stuff is really in play. And all that's kind of happening is data packets pinging around the different stock exchanges in the US and the different dark pools, which are other trading venues that are all trading the same stocks throughout the day. And so you have these sort of like short-lived little information asymmetries that can be leveraged to predict prices at that time scale. So this chart that you're seeing here is the sort of prediction accuracy of a little model that I built to predict when stock prices are in transition. And the full model is over here on the right, which is a logistic regression of these 9 things. And somewhat shockingly, this little logistic regression was the subject of a lawsuit between the SEC and Citadel not so long ago in the United States. So I like to say that this is my sort of one appearance in the Wall Street Journal. You have to kind of squint at it, and I'm not sort of in there by name, but I'm the math that I built is kind of baked in there because Citadel sued the SEC, which is the regulator of the U.S. stock market, the Securities and Exchange Commission, over their allowing IEX to use this little formula in the structure of their stock market. Which was kind of a surreal experience to be like listening to the Zoom like court proceedings in that lawsuit, and having these lawyers from Citadel go up and say like, it's madness, you know, no one can understand what the AI of these order types is doing, and how could you allow this? And I'm, you know, screaming into the void of my laptop with no one listening. It's like, it's a sum of 9 things, dude, like calm down. But just to show you, like, the math of this is kind of like not the hard part. Like, this is just a little mathematical pattern that describes something about the physics, about how data packets interact in these 16 exchanges, basically, and not really something fundamental about the economy or any of that. But you can tell that it's a sort of battlefield that people make a lot of money or lose a lot of money in, because people are willing to go to great lengths to kind of protect that territory. So this is just a little bit of the background of the sort of real system that all this sits in, and it can be a little, it can therefore feel a little dry and sort of insufficient to describe the stock market the way that mathematicians or economists often do, who sort of think of this as a random process. So you may have seen sort of classical economics treatments of stock price as a random variable, as a kind of Brownian motion, as a thing that's a random walk through space that's just kind of going up and down over time. But the more you sort of sit and stare at this kind of picture, the more you realize that, you know, it must be obscuring a bunch of much more interesting detail. Because if we even dig into the sort of description here, that the price of the stock at any given point in time is a random variable, we're actually already sort of skipping over a lot, because what do we mean by the price of something? So just a few examples of what we might mean. It might mean what someone recently paid for it. So it might be the price of a recent trade of that thing. It might be what someone says they're willing to pay for it, even if they haven't sort of purchased it yet. It might be what someone is willing to sell it for. It might matter who, it might matter under what conditions, it might matter how many units are being bought and sold at a given time. And so all these different levels of nuance actually create a large space of possible definitions of the price of a stock. So there's already a lot of complexity sort of hiding in the phrase, the price of a stock. And so what it looks like from a more data science, computer science-y perspective is that we're actually looking at a discrete time series of little events. And actually we're looking at an overlay of 3 time series of events. One time series here in blue is people sort of announcing and then a willingness to buy a particular stock. So these are called bids. And so your data set might look something like this, where you have this axis of time kind of running along the bottom. And you have somebody saying like, hey, I would buy 100 shares at $6. And maybe they either trade or they go away or they update their price. And then later you have someone saying, I would buy 100 shares at $5.50, et cetera. overlaid on top of this, you have a time series that's in red here of people announcing an intention to sell things. So you have, these are called offers. Why offers are offers to sell instead of offers to buy, I couldn't tell you. I think the terminology here is a little it's a little tough to remember what's what, but the standard terminology is sort of bids and offers, although offers are also called asks for some reason. So you may see that too if you ever have the inclination to read a bunch of finance literature. Offers and asks are the same thing. They like to have many words for the same thing. I haven't figured out yet why why that is the case. But so we have this overlay of bids and offers, and as you can imagine, like if they crossed, then usually you would just have a trade. So if you have someone offering to sell at $8 and you have someone willing to buy at $8, and they sort of trade with each other and they leave the system. So for the most part, you kind of have this red time series of offers like floating kind of above this blue time series of bids. And every now and then you have someone meet at one end or the other or somewhere in the middle. And so you have this purple time series of trades that are kind of, that are when a buyer and a seller actually agree on the terms and the exchange matches them up and reports that as a trade. And this kind of overlay of time series is basically public information. So you have to pay various vendors to get it in real time if you want to get it super fast. But generally speaking, this is kind of a view that everyone is able to see if you're participating in the system, that you will know what was traded in what quantities and at what prices and exactly when. And you'll get to intersperse that with these kind of bids and offers to build a view of what's happening across the market. And what I've pictured here is kind of what's happening at any one venue that's matching stocks. So like on the New York Stock Exchange or on NASDAQ, but actually you have this in parallel kind of running for every stock in 16 different exchanges independently, and then over 30 different dark pools. So your data set looks like sort of what I've shown here, scaled out in time, scaled out across over 40 different venues, and then scaled out across over about 12,000 different stocks on a given daily basis. And so I feel like I've just thrown a lot of brain dump information at you. So maybe it's a good time to pause if there are any questions so far.
I do have a question. I don't see any in the chat. Has there been any attempt to, I don't know, define kind of like a fair stock market from kind of like more of a security cryptography point of view, or?
In the sense of, I guess there's yes and no. So there's lots of different proposals onto what a sort of like market structure could be. And a lot of people's impulse coming from the cryptography world, I think, is to say like, well, it should be a secure multi-party computation between all the parties. And there have been proposals along those lines of like, you have your kind of like parameters of what you're willing to trade, and other people have their parameters on what they are willing to trade, and nobody wants to reveal their intentions other than the output of like, what is the match trade? And that kind of in microcosm is basically what an auction is. And so like every morning at the beginning of the day and every day at the closing at the end of the day, there are these auctions, which are kind of little microcosms of a secure multi-party computation. But basically everybody trusts the middleman, everybody trusts the exchange to do that matching. And it's not because they like really trust the exchange as like as a for-profit entity that they just kind of believe has their best interests at heart, but it's because it's super regulated. So like if an exchange is caught doing anything that's not the literal application of their published rules with the SEC, and the SEC collects all the data and you can audit and all these things. If anything goes weird in the auctions or during the regular trading day, people will get fined and go to jail and go out of business and all that good stuff. So the problem of having a central authority from a trust perspective, isn't really kind of like the main problem. The much more sort of relevant problem is like, well, what set of rules actually set up good incentives for people to kind of, you know, trade in line with their intentions, and so that, you know, some participants don't just sort of benefit at the expense of other participants. And that's kind of hard to map very simply down onto a cryptography problem, because basically it's like nobody really believes that the message traffic is getting sniffed. I mean, there are some sort of there's tons of shady stuff that people have been caught doing, but it's mostly like it was technically inside the rules. So it's more like the hard thing is understanding what the output of the continuous computation leaks, more so than like protecting the communication itself, if that makes sense. And so the question of like defining a fair market from scratch, it's like the question is like a multifaceted question of like fair to whom, under what circumstances, and there's lots of competing proposals for huge departures from how this works today to tiny tweaks that are sort of always being floated around, and it's kind of the SEC's job to like incrementally propose and change things. But yeah, there are a lot of people advocating, for instance, that this like continuous nature of time causes a lot of problems, of people like sneaking ahead and front running and high frequency trading being predatory and all these things, which was something we very much kind of studied. You know, my little model of how stock prices change is predictable at a millisecond level. That's all a consequence of this continuous time dynamic in a decentralized system. So you could get rid of that and you could just have auctions. So there's a proposal of like frequent batch auctions where it's like every minute or every 100 milliseconds or whatever, we run an auction, and that's the market instead of this continuous time series. So it'd basically be taking this and just collapsing it into a sequence of auctions. There's not really a strong reason not to do that, other than that nobody who trades wants to do that. So, and the psychology of this is fascinating to me, because there's another thing that's super funny, which is that there are half days in stock trading on certain holidays. So like sometimes, you know, like the day after July 4th or the New Year's Day or whatever will be a half day. And what that means is that we trade from 9:30 to 1 instead of 9:30 to 4. And one of my jobs at my current company, because we're a broker dealer and we do trading algorithms on behalf of other people, one of my jobs is to like make a little model that says, okay, historically, the distribution of volume over the day kind of has this shape. It's called a volume curve. And we try to trade sort of in, you know, in a mirror image of that kind of shape to just kind of blend in with everybody else. And whenever I run the model on like the half days, it looks like the full day just kind of squished. So like if you just take the same model and you prorate it, so if you just scale it to the half day, it works like as well. And which really makes me think, it's like, why don't we go home at 1 every day? Like all the math looks like it's the same. And so like a lot of this stuff, it's really hard to map to a computer science problem the reason why things are the way they are.
Okay.
Just kind of a meandering answer to your question, but that's just one of the funniest things I've seen as like a data scientistic stock trading, is that the half day looks like the full day but scaled, and I'm like, well, why stop there? Like we could be here for half an hour and go home. Like to set the scale factor, whatever you want, which is very funny to me. Yeah.
Yeah. Thank you.
Yep. But yeah, so this is a great question to keep in mind, which is like, what do we really want out of this system? Like what things are good about it, what things are bad about it, what problems like are positive to solve here. Yeah, so this is just an animation of what I already said. So just to zoom out for a second and give you like a full view of everything that's happening. So like this is a sort of basic schematic of the US stock market as it exists today. And so like your end investor up here in the diagram is somebody who's sort of deciding to make a trade or deciding to like put some money in a 401k. Your portfolio manager is deciding like what to trade. Then you go through several layers of technology, like an order management system, to a trader who decides which brokers to send it to, who use algorithms to send it into dark pools and stock exchanges, et cetera. You have proprietary traders off here consuming all the same data feeds and trying to jump in there or trade for themselves and predict prices and all that kind of stuff. So this is the kind of mess of sort of what this looks like now. And the obvious question to all of this is like, but why is this so complicated, right? Like nobody from first principles would design a system like this. But some amount of it comes from a kind of natural separation of duties or separation of powers, if you will, which comes from different time horizons as well as different sort of layers of expertise. So at every step in this chain, it's like you're kind of following this sequence of questions. As an end investor, you're asking, what are my goals and time horizons? If you're a portfolio manager who's investing people's retirement money and you want it to go up over time, of course, you're going to be asking questions like, well, what are my opinions about a particular market or sector or stock? What do I think is going to go up? What do I think is going to go down? That leads you into the question of, okay, so what specific stock do I want to buy and sell and how much? And then there's a question of speed. Do I want to try to buy a lot really fast, which might drive the price up, or do I want to be patient? And so you have that kind of trade-off. And then at the end of the day, you have all these different marketplaces where you could buy or sell the same stuff. They have all these different order types that you can use to try to do that. You could try to do it in big chunks. You can try to do it in little pieces at a time. And so you get this kind of natural specialization that sort of happens in the space that kind of leads to the complexity of that diagram to some extent. And so these decisions all end up being made by different people who sit at different layers of that sequence and in different companies often throughout that chain. And so in the ideal world of an economist looking at this, what's supposed to happen here is that a buyer and a seller are going to kind of naturally meet in the middle. So we have someone saying that they think the stock is going to go up and they want to buy 1,000 shares. And you know, someone saying, I think the stock is going to go down, I want to sell my 1,000 shares. And in an ideal world, that would happen. And then sort of deciding on a price to meet in the middle that they're both happy with, that process is called price discovery. And the idea is that sort of organically crowdsourcing this across the market is how we get the most sort of up-to-date and intelligent prices that we can. But of course, the major complication here is the mismatch sometimes between buyers and sellers and how much they want to trade and when exactly they want to trade, and especially the when. Because what tends to happen is you have some investor, let's say, who wants to buy 1,000 shares, they enter the market, they wait around for a little while, they go away. And then later you have an investor who wants to sell 1,000 shares for, let's say, even a compatible price or the same price. They enter the market, they wait for a while, they go away. And when I say a while, this is another thing that's crazy to me, but I often mean like less than 5 minutes. Like a lot of times when human traders who are actually trading this stuff, if they don't get some bills, which are trades, got 2 names for everything for some reason, they will sort of go away and try something else in sort of less than 5 minutes or so. So we're not talking about a lot of patience here from a time perspective. And in that case, of course, if they don't find each other, you get no price discovery. And so this is why we sort of get all these companies who are trading for themselves and making money without really having long-term opinions in what stocks are going to be going up or going down. So you've probably heard of companies like Citadel if you've been sort of following the US market and some of the controversy over Robinhood and payment for order flow. But those companies don't typically, or the divisions of those companies that that trade with Robinhood users or do those kind of services, they're not actually taking a stake in what stocks they think are going to go up or down. They're doing something called market making. And market making is supposed to be the service that sort of bridges these gaps in time. So you have an investor who comes to buy and the market maker sells to them. And then you have an investor who comes later to sell and the market maker buys from them. And the market maker's goal is to kind of end the day even. So they're trying not to hold too much risk. They're trying to buy roughly as much as they sell. And the service they're providing is that they're there all day so that nobody has to wait. So they're kind of bridging that time in between the buyer and the seller coming. And because they hold risk in the meantime, because they might buy from someone and then not be able to find a seller at the same price, they need to be compensated for that risk. And so they will typically set their prices so that they sell for more than they buy. And they'll dynamically update this range to kind of balance supply and demand. So if they find themselves buying a lot and not selling a lot, they're going to raise the prices to kind of rebalance that and hope that they can sell some, and et cetera. So this is sort of the service of market making, which is called liquidity, which is just sort of providing the ability to trade quickly. And the gap between their prices is called the spread, which is supposed to compensate for the temporary holding of risk. So this is what this sort of looks like in a more practical sense. And what this ends up doing, so I'm going to skip over this part for time. I just want to say that this is kind of what ends up like fragmenting that overlay of time series that I showed before. So if I go back to this picture, in this picture, sort of most of my dots represented actually relatively small units of stock trades. So like 100 shares, 200 shares. If we're talking about like hedge funds trading with each other, these are kind of small amounts, because what's really happening is not some big hedge fund that thinks GameStop is going up trading against some big hedge fund that thinks GameStop is going down. What happens is they're each trading with the market maker when they show up to the market. And the market maker doesn't want to trade big chunks at a time. They're trying to do this balancing act. So that's how this ends up sort of with big trades being fragmented into a bunch of tiny little trades over time. And so the market maker is kind of what's happening to make this little time series sort of stretch out over time in some sense. Okay, so I wanted you to have that context, but I'm going to skip ahead to have more time to talk about what I think is the interesting computer sciencey problem here. So if we think about this process of the market maker sort of balancing supply and demand, in essence, they're trying to notice patterns. So they're themselves trying to extract information as to where is this going? Like, am I going to get run over? Like, am I going to get stuck holding the bag as prices go up? And I, and I need to, and I get stuck having, sort of sold low and have to buy high or something like that. And so they're trying to extract information from this process, and this process of trading, of people coming to the market maker or coming to the market in general, is an act of communication that is potentially sort of leaking patterns or leaking more of your intention to trade than you would necessarily want to or necessarily be aware of. So people in their interactions with the market, especially when you sort of aggregate all of these time series happening simultaneously in all these different places, you may leave unintended and unnecessary patterns that can be exploited. And so economists or pure theoretical economists would perhaps argue that anyone who's exploiting a pattern and making money off it is therefore providing a service. And in some cases, like when we talk about the market maker bridging the gap between buyers and sellers, if they would be waiting for an hour, or they'd be waiting for a day, or they'd be waiting for 10 minutes, perhaps it is sort of clear it's a service. As the time scale shrinks or in some other conditions, it's like if they would have been waiting a millisecond, it's not so clear that just adding an extra intermediary to that is providing a service. But formally drawing a line between such things is a difficult definitional problem, because we really have to understand and track how information flows through this kind of system. But what I think is a more approachable question here, and a more reasonable target for computer science research, is the question of, if we're trading, if some of those trades and some of those bids and offers in that overlay of time series are us like trying to accomplish something like buy a lot of stock over the course of the day, how do we measure or control our information footprint? And to put this in kind of vague terms, but to make the analogy to sort of cryptography, in some sense, we're asking, what is a definition of computational indistinguishability for this kind of continuous time series? Because at the end of the day, if we don't want our intentions to be leaked to the market, if we're a big buyer of a stock and we want to play it cool and we want to just sort of buy little bits and pieces here and there, I'd be like, oh yeah, like I'll pick up 100 shares of Microsoft, no big deal, right? And we don't want to sort of leak the information that we actually want to buy a lot. Then in some sense, what we want is for the time series with our activity and the time series that would have been without our activity to kind of be computationally indistinguishable, right? Like in some sense, what we want is that our activity doesn't kind of disturb the time series in a noticeable way, so that someone else who's watching for those patterns is not going to trigger based on something we did. And so we can formulate this as a kind of game. And so putting it into sort of typical like cryptography terminology here, let's say our Alice wants to buy a lot of stock. Eve is going to measure something about that time series of trading activity. And the market in general is going to be modeled as a random process. And we're going to look at the distribution of Eve's measurement relative to the world where Alice is trading and relative to the world where Alice is not trading. And it's Alice's goal to make those worlds look as close to each other as possible. And so the closest analogy here really, rather than indistinguishability, is really kind of differential privacy. That there is going to be a difference between the distributions of those worlds, but we want to control the quantitative version of that. Like we basically want to make sure that we as a trader, or Alice as a trader, is not doing something so obvious that's like, well, nobody else does that, right? Or like nobody else leaves that kind of pattern. So that's the kind of way we can turn this into a privacy goal. And more concretely, how this works is you can actually define this as a repeated kind of distribution testing-ish kind of game. So we can imagine that a round of this game works in the following way. We have a distribution for some kind of numeric random variable, and that's known to everyone, because everyone can kind of look at this data historically and build a model of what the sort of random process of the market should look like. We're going to now say that the next step of the game is that a value is going to be sampled. So maybe, you know, maybe our measurement for capital X is like how much volume is going to trade in a certain time period. Maybe it's some other sort of feature of that overlay of time series, whatever it is. Everybody in the market kind of knows the default distribution. And then some real event is going to happen, is going to be sampled. And we can imagine our trader Alice as might have some kind of auxiliary information. So if we just want to be pretty general about the situations that we're capturing here, we're going to model that by giving Alice some auxiliary information. We can obviously set this auxiliary function to be empty if we don't want to give her any information. We can set it to be the full sample X if we want to give her a kind of last mover advantage so that she knows what the market is going to do and then she does something. And there's a range there based on what we choose as the auxiliary function. And then Alice is going to pick an action. So she's going to decide, okay, given these market conditions, to the extent that I know them, here's what I'm going to do. I'm going to try to buy 1,000 shares, or I'm going to sit out, or I'm going to whatever it is she's going to do. And we're going to think about that as sampling, as choosing from a family of distributions. The effect of her action might also have some randomness to it. So that's going to get sampled. And then just to keep things simple with kind of an additive structure, let's imagine that her trading activity gets added to what would have otherwise happened. And we get a final outcome of like X plus A. So there would have been trading volume X without Alice, and now there's trading volume X plus A. And we imagine that the adversary who's watching this, they don't get to know the exact separation between X and A. They just know the underlying distribution, capital X, and then they see this value X plus A. And we'll say that X plus A here is the sample of a random variable X tilde, which is a random variable that's kind of capturing the world with Alice trading. And you could repeat this over and over again because you can imagine an adversary kind of making sequential measurements of whatever sort of property of trading activity they're using to make their own decisions, and they could do this at some frequency throughout the day. And our goal here, our privacy goal, is going to be to keep the distribution of this value X plus A under a kind of differential style privacy bound relative to the original distribution. So we can define a problem here where Alice's goal is to have the distribution of the world with her trading stay inside, let's say, an e to the epsilon kind of upper bound. So I just took every point here in the distribution of X and multiplied it by e to the epsilon. And we want to stay under that. And what that would mean is that any event that could happen, like a bad event, like the price being raised while Alice is trying to buy, or any kind of similar thing, the probability of any bad event in the world with Alice's actions is not going to be greater than e to the epsilon times this probability without Alice. And so it's not going to be that suddenly, everything was going to be great, and with 100% probability because of Alice, it's now going to change. And so that can sort of bound our information leakage in this sense. And within this, Alice is going to have a utility goal to trade as much as possible, to get done as much as she can get done without getting caught, basically, or without getting noticed. And she might have secondary goals, like also minimizing her variance of her trading strategy within that. And it turns out, so you can take real distributions and you can formulate these kind of things. And you can also sort of look at various kind of trading strategies in terms of what they would do to the distributions in this framework. So a very simple one is if Alice just adds a constant amount of activity to the distribution, it's just going to be a shift to the right. You're just going to get something like this purple curve here, which is generally going to violate the sort of privacy bounds, but we can sort of understand it in this framework. Whereas if we try to treat this as an optimization problem, Alice can probably achieve something more like this. At least this one is in the context of having pretty strong auxiliary information. She can sort of shape things so that she can increase her expected value without sort of overrunning that privacy budget if she kind of pushes the distribution basically up to that privacy bounding curve. And it turns out if you represent your distribution here as a discrete vector, then this just becomes a linear program. And so we can actually solve for Alice's optimal strategies here by solving a linear program. And we can even work in goals like variance and other things to, even though variance is generally a quadratic constraint, what we can do is we can sort of find the true expectation by solving a linear program And then we can plug that in as a constant to express the variance, which then becomes a linear function, and we can solve a second linear program. So it turns out that sort of solving for these kind of purple strategies here is very doable. You can just sort of set up a linear program. And if you do it in practice, it looks something like this. So this is an example with real stock data for an ETF called SPY, which kind of tracks the S&P 500. This is the raw distribution for a volume metric on the left here, fit with a spline, with a cubic spline, I believe, in the red. And then this is kind of what the trading strategies that would stay within this. In this case, I set e to the epsilon to be 2, just so things would be pretty drastic and you could see it. And you can sort of see what a trading strategy that stays inside the bounds would look like here. But there's a lot here still to do. And as you can see, this kind of repeated game definition is pretty basic and very obviously related to differential privacy, to multi-party computation, to distribution testing, etc. But I'm not aware of any other exact sort of parallels or uses of this so far. But it seems like a kind of natural object to analyze in the context of cryptography and information theory. And the applications of this kind of extend in a lot of different directions. So as future work, we have a lot of work to do in terms of understanding what are the measurements that Eve should be tracking. And in particular, they're going to be multidimensional. You can look at many different features of the trading activity to try to look for patterns. And there's also, as you can sort of see, these distributions are kind of very ugly, and they have these sort of outlier points and heavy tails sometimes. This one is one of the cleaner ones because the S&P 500 is kind of an average of things which are themselves individually noisier. So there's a lot of just like detail work to be done in terms of smoothing and handling tails and outliers. There's a lot of work left to do in how do we actually put this into trading products, and also how do we think about this as a way of grading and managing information leakage for people who are trading across stocks, which is a sort of natural extension of this. But I just wanted to give you a bit of a flavor of the sort of analogy here, and basically of how this kind of game definition ties into analyzing patterns of market activity. So I know I've been now talking at you again for a long time. So let me stop here, and hopefully there are some questions.
Yeah, thank you very much, Alice. This is very interesting. I have some questions, but I'll let others ask their questions if there is any. And Jiangshan, go ahead.
Hi, Allison. Thanks for sharing the interesting topic. So, well, I understand roughly about the background and the approach that you are trying to have. I probably missed the part that the importance of the information leakage, in particular, about the trading pattern of a certain user to the user, and also potentially to like the market maker. So can you help me to understand, like from the user point of view, like as a trader, like Alice in your example, why is this important to consider if we are going to, commercialize this solution? And as a market maker, probably I do have access to, the bank and the account information, and I potentially have an idea of all the historical trading of a particular targeted user. And can I leverage this information to do something malicious, given you said that this is a very well-regulated market? So I just want to have a bit better understanding on, what can we do with this, assuming that if, we are working with the leaked information, how that harms us as the trader and how that benefits the market maker.
Yes, yeah, excellent questions. Yes, there's a lot there. Let me take that piece by piece. So So the first question of yeah, so the user. So I should also say here, there are two very different kinds of traders in the US market. The sort of retail trader is the name for like, you know, individual people kind of trading just for themselves. And most of retail orders are small enough that they are sort of on this picture, one dot. So we're mostly not talking about those. There's super interesting questions about those, but putting that aside for this perspective. So our user, when we're thinking about the value of this to the user, our user is a hedge fund, a pension fund, you know, Vanguard, sort of trading all of our 401ks at once, that sort of user. And for that user, so they are sort of, let's say, going into the market and saying, all right, I want to buy Microsoft. And I should say, I always use buying Microsoft as an example because I used to work for Microsoft. So there's just a reason why I do it that has nothing to do with actual stock data. This is not a stock tip in any way. So and it's also the only stock I've ever like personally bought and sold because they gave us like an employee discount. But so we're talking about somebody going in to buy like Microsoft, and the amount that they're going to buy holistically is going to be like 30% of the market in Microsoft for that day. And they might decide to spread it out over 5 days, but that's kind of like the target is so big. And so that's going to be like a bunch of little dots, some fat dots, some tiny dots, like over hours, over days, over weeks, potentially. And you hit upon an interesting point, which is like, well, what does the market maker have access to from a data perspective to try to figure this out? And in the US market, and this is actually a difference between the US and at least some other markets. I'm learning about the Brazilian market today because we're doing a like data project for someone in the Brazilian market. And they actually do get to see like who the broker was that traded each order. In the US market, it's completely unattributed. So the market maker doesn't know, because the way that, so going back to, where's my picture of the structure of the stock market? Going back to this, when the market maker actually makes a trade, they do get to know like who's the counterparty on that trade. But that's going to be the broker who's kind of this layer, you know, obscuring the end hedge fund. And the end hedge fund might be going through 10 different brokers. And so like the market maker doesn't have that information completely attributed or even attributed anyway of like who, so like these hedge funds trades are going to potentially look very different and be unlinkable to some extent to the market maker. But the market maker may try to extract certain patterns of like, well, whenever there's this kind of trading activity, prices tend to go up, or that tends to represent a big demand that's like coming down the pipe, etc. And so like that's the kind of game that like market makers and just other proprietary traders who have no interest in providing a service but are trying to predict prices, although some people would argue that's a service, and in some sense it is. But people just sort of trading on their own behalf who are trying to sniff out these big orders and sort of exploit the knowledge that big order is there. And I shouldn't use the language exploit there either, because like in some sense it's like a big order is supposed to move the market. The market is supposed to represent the balance of supply and demand. So this isn't really like a good and evil battle at these time scales. Like this is really a natural competition that's supposed to happen and is healthy to happen between big orders trying to blend in and people trying to sniff them out to raise the prices to adjust for demand. This is just kind of like the natural ecosystem that's like happening. But there certainly is value to the big player to disguise their intentions as much as possible. Right. Because if they get caught out, they're going to end up paying way more. And we can see these kind of reversion effects where like sometimes, you know, the price will rise and rise and rise because there's big demand, and then it's gonna, when that demand goes away because that big buyer is done, it's going to collapse partially back. And so people can argue for years over like what was the quote unquote correct balance there. But we probably are talking about ultimately billions of dollars sort of at stake in this process.
Right. So this is super complicated to me, but I immediate follow-up question to what you explained to me. Thank you very much for that, by the way. Is that I think there are two aspects I see. One aspect is from the broker point of view, namely, in terms of the actual motivation and incentive for them to operate, is this a major motivation for them to get extra revenue by getting this insider information from the leaked information? And if we eliminate that, what would be the consequence? So that's one aspect. Probably we don't have an answer, which is fine. And the other aspect is that as the vendor who buys a lot of stock in a short time, is this something really bad for them if the stock market goes up because of their action and because of the information leaked to the outsider, so that they start to all get to buy in the same stock? Is that really a bad decision for them? I'm not sure, like, because it seems that if I spent 30K to buy the stock market, and at the end I only had the chance of spending 20K to buy the market with the price I want to have. But then the market has gone up since then quite a bit because people knowing that I'm doing so. It also seems to be a good decision to make as well. So I'm just having those kind of feeling that it's quite complicated as a problem, right?
Yeah, and this is where I think time is what makes this a super complicated problem, because different players in the market are operating with different timescales as their goal. So like the hedge fund that's like buying on the stock may be doing so because they think the price 6 months from now relative to today is going to be higher. That's their hypothesis, right? So they're planning to buy this and hang on to it. And if they're right, they'll make money. And if they're wrong, they'll lose money. The market maker is trying to make money on a time scale of a day. And so like you can have this kind of mismatch of timescales where things can be symbiotic or things can be bad for both, or sort of every combination. But what ends up happening, at least in some cases, and the other thing that's complicating all of this that really annoys me about the psychology of human traders is that you can't even point to a specific example, and just based on price, they're like, oh, well, people noticed you, so the price went up. Because like there's a million reasons why prices go up. And it's like some of them are completely independent of you and all these other things. And it's very noisy and it's very hard to kind of attribute. But the general thinking is like, if you're like a big buyer and you're causing the price to go up, that incorporation of your demand into the price is going to be shorter lived than the timescale on which you're trying to make money. So like the market is going to be like, oh, there's a big buyer and it's going to go up. And then by tomorrow, when you stop buying, it's going to basically be back down to maybe like, just like 10% higher than it started, and maybe it went up like 200%. Those are crazy high numbers, but just to give you, a sense. And so all of that price raising that was responding to you don't really get the benefit of it for the stock you already bought because it's too short-lived for your time scale. And so like, things happening against you in a time scale shorter than you're trying to make money is bad for your business and can ultimately lead to people like not being able to implement strategies that they would otherwise implement. And so, and this is not, a black and white good or bad thing, but that is why like you have a certain amount you need to buy, usually as a function of like the amount of money that you're managing. Like if you're managing money for all these different people and you're like, okay, we need to kind of move the entire portfolio in this way. And if you do so and you're kind of the elephant in the room and the prices kind of respond to you, they're probably going to deflate back by the time you have to sell the stuff. And so you just lose money in that process and don't really gain from it. And so that's kind of a large part of the complication here is interlocking timescales that are sort of different from each other.
Thank you.
Yeah, I think for the sake of time, we may need to conclude here. But if you have any questions, I guess you may reach out to Allison if she's happy to take questions over the email.
Yep, I would be happy to take any questions on any of this stuff. I should also say one thing that's kind of weird about my company as a broker is we do publish white papers about all of our research. So this, in addition to all the models behind our trading algorithms, are public information. This one's not posted yet, but it will be in the next few weeks. And I'm happy to talk to people about any of this stuff or share any of the resources we have for anyone who'd like to think more about these kind of problems.
Yeah, thank you very much, Allison. And thank you everyone for tuning in. Hope to see you in the next seminar. Thank you.
Thank you.
Thanks. Bye.